evening, ladies and gentlemen. Welcome back to yet another Mayberry Investor Forum program. I'm your host, Dan Theok, Senior Vice President of Investment Banking. And today we will be looking at the results for NCBFG for their first quarter. On the panel, I'm happy to welcome back Mr. Rob Almeida, the CEO for NCB Financial Group. Welcome, Rob.
Thank you. Thanks for having us again.
Mr. Malcolm Sadler, Group CFO for NCB Financial Group. Welcome, Malcolm.
Yeah, thank you. Good day, everyone.
And the Trinidadian invader, Angus Young, CEO for NCB Capital Markets, my favorite guy. Hey, welcome, Angus. How are you doing?
Hi, Dan. Thanks for having us.
Our pleasure. And also on our panel today, I'm going to be joined ably by our chairman, Gary Parrott. Welcome, Gary. And our CEO for Mayberry Investments, Patrick Bataille. Welcome, Patrick.
Thank you, Dan.
Apologies for the absence of our chairman, group chairman, Christopher Berry, but I think we've got a really good panel here, so we'll be fine.
Dan, who's the young lady?
Who's sorry? No, I think that's somebody in the background, a figment of your imagination, not on the actual program.
Oh, the Belinda lady?
Yes, a figment of your imagination. Well, folks, if you're a fan of the content, don't forget to subscribe and hit the bell to stay up to date with our channel. And if you're looking to make your very first investment journey, you should take that first step with Mayberry, of course. Follow us on social media today or visit our website at mayberryinv.com to learn more about how you can get started today. Also, make sure to stay up to date with us until the end of the program, where we'll have our live Q&A segment where Robert, Malcolm, or Angus will be answering your questions. So go ahead and drop your questions in the chat now if you wish, or as we go along, and we'll answer as many questions as we can. Well, it's the big day. We've got the big boys back in town again. My number one favorite stock, it's NCB. I don't hide that from anyone. And we set you a task, Rob. I'm sure by the end of the program, you'll tell us you hit that number. But before I do the spoiler alerts, Malcolm, let me turn it over to you to tell us what happened in the quarter that was.
Okay, thank you. Thank you, Moderator Dan Theok, Mayberry executives, investors, and other stakeholders, all guests joining us today. Good day. I'll take you through the highlights of our quarter one, December 2025 results. The group reported consolidated net profit of 5.1 billion for the quarter. And it's actually a 1% lower than the comparative prior period. And also in relation to net profit attributable to shareholders of the company, this amount was 2.5 billion, 4% below quarter one of the prior year. In terms of our performance metrics, both the ROE and ROA, in terms of return on equity, return on assets, trending below last year as well. However, cost to income ratio has improved by around 100 basis points. Not a significant improvement, but it's trending in the right direction. To note, during this quarter, or the most recent quarter that we reported on, the impact of Hurricane Melissa resulted in higher insurance claims and also higher expected credit losses and lower fee income as well. During the quarter, we also had fairly significant unrealized fair value losses on equities in the insurance segment. Overall operating income for the quarter totaled 33.5 billion. And net revenues from banking and investment activities totaled 25.4 billion, down 25%, largely due to an overall swing of 808 billion fair value index and investment activities, gain on FX and investment activities, an overall negative swing, mainly due to the mark-to-market adjustments on our equities portfolio. Insurance service result was 9.4 billion, actually up 25% from the prior year. Insurance revenues were relatively stable compared to the prior year. Insurance service expenses increased primarily in the property and casualty segment. These expenses included gross claim payouts for Hurricane Melissa, which totaled US 161 million, or in excess of 25 billion Jamaican dollars. Net expenses from reinsurance contracts were lower, as reinsurance recoveries also related to the hurricane total 148 million US dollars, which is in excess of 23 billion Jamaican dollars. As a result, the net costs associated with the hurricane amounted to 12.5 billion, which is close to 2 billion Jamaican dollars, and that's the net claim after you adjust for the recoveries. If we move to the second slide, net insurance finance expenses declined by 81% compared to the prior year, driven mainly by the life and health insurance segment. Unrealized fair value losses on investment securities also affected our unit-linked products, which combined insurance coverage with the investment component. The reduction in insurance finance expenses reflected changes in the fair value of underlying assets of the contracts. This was partially offset by favorable movements related to the effects of changes in interest rates and other financial assumptions and interest accreted. Net interest income increased by 4%, mainly due to the management of interest costs and the net interest margin. Net fee and commission income declined by 8% when compared to the prior period. This was primarily influenced by two factors: customer relief financial solutions provided following the passage of the hurricane, which reduced fee income during the quarter. We also had some refinements to the credit adjudication process for certain digital loan products as part of our strategy to enhance asset quality. This resulted in a moderation of loan originations for the quarter, which in turn impacted the fees earned. Operating expenses declined by 5% to 26.2 billion. The reduction was primarily due to lower operational losses during the quarter recorded compared to the previous year. The quarter also included asset tax of 2.7 billion for regulated Jamaican entities. If we go to the third slide, look at our segments. 6 of our 7 segments recorded operating profits, while 2 recorded higher profits compared to the prior quarter. Our life, health, and pensions segment recorded operating profit of 7.2 billion, actually down 10% from the prior year, despite recording losses on investment activities due to lower equity prices. There were positive movements in insurance service results and insurance finance expenses. Our treasury and correspondent banking segment reported operating profits of 2.9 billion, an 8% decrease versus the prior. This was mainly due to a decline in net interest income, which was partially offset by higher gains from FX and investment activities. Wealth, asset management, and investment banking reported operating profits of 1.8 billion, an increase of 35%. The main drivers of this increase were increased net fee and commission income and higher dividend income. Our payment services segment delivered operating profit of 1.7 billion. This is more than doubling the prior year, with an increase of 164%. This performance was driven by strong growth in net interest income and fee and commission income. Our general insurance segment recorded operating profit of 1.3 billion, and this is actually a 39% decline compared to the prior. This was driven primarily by a 1.5 billion reduction in insurance service results due to the net claims arising from Hurricane Melissa, as well as losses on investment activities. Our corporate and commercial banking reported operating profit of 1.1 billion, a 20% decline from the prior. Net fee and commission income decreased while expected credit losses increased. Our consumer and SME banking segment reported an operating loss of 491 million compared to 231 million loss reported in the prior period. This segment had reduced fee income due to the changes in the credit adjudication process for certain digital loans, together with the reduced fees due to Hurricane Melissa. There were also increased expected credit losses due to the impact of the hurricane. These adverse variances were partially offset by higher net interest income. If we go to the fourth slide, in terms of our financial position, total assets as at December 2025 was 2.42 trillion, an increase of 6% or 129 billion compared to December 2024. And this was driven by the investment securities, which totaled 1.26 trillion, an increase of 11% or 122 billion. Net loans and advances totaled 608.4 billion, a decrease of 1% compared to December 2024. Customer deposits increased to 837 billion, and this is actually up 7% or 56 billion. Insurance contract liabilities stood at 564 billion, up 6% or 31 billion compared to December 2024. Equity attributable to stockholders of the company totaled 197.5 billion, actually up 17% or 29.3 billion over the prior year, primarily due to growth in retained earnings along with increased fair value on insurance finance reserves. As at the end of December, all our regulated entities exceeded their regulatory capital requirements, and we also declared a Q1 dividend of 50 cents as of December 2025. Thank you, and I will now hand over to our Group CEO, Roberto Almeida.
Great. Thanks, Malcolm. Dan, do you want to go next, or should I make a few comments here?
Yeah, sure. Why don't you go ahead and make a few comments on it, and then I'll have a much abbreviated presentation because you guys have knocked it out of the park.
Okay, great. Thanks. So I'll be really short. We around 2020, just to get a little bit of context. When I first came on this show, it was around late 2023, and we kind of started a turnaround, and we were very clear that we had to start a turnaround. And so the 2-year period between September 2023 and September 2025 was all about that turnaround. So our operations had issues. We were increasing our debt. Our equity was going down. And we had a whole lot of debt that was maturing over the next 12 to 18 months, which meant liquidity at the holding company was also challenged. The focus for the last 2 years has just been discipline. It's discipline on a number of different fronts. So when you see the thematic in our annual report, which is a gym, it's not one part of the messaging is about being that we're strong, but the bigger part of the messaging is about discipline, it's about consistency. And that's been the focus. And coming out of the end of 2023, 2025, and now into the first quarter of 2026, the number that you always held me to, which is that 5 handle. So it's
Right,
kind of that
right.
$5 billion, $5 to $6 billion a quarter, core recurring. And so we've had a lot of volatility over the prior years, but over the last number of quarters, we've been pretty well consistent out of core recurring earnings with the $5 to $6 billion. You didn't see it in Q1 because you have to normalize for the asset tax and you have to normalize for effects of Hurricane Melissa. But if you normalized that for those two things, you end up in that $5 to $6 billion, and it's core recurring net profit attributable to shareholders of the company, so net of minority interest, and that's given us the platform. So our AVMs have cash. We were the ones to bring cash back into communities after Hurricane Melissa. Our branches were running. So our operations are resilient. We've moved everything to the cloud now, and our end of days, just simple things that people don't think about. Our end of day runs shorter, which means we got more of a buffer in the morning if something hiccups, and we'll still open up on time. There's a number of different things like that, from the capital side to the debt management side. We've brought down our leverage, we've grown our equity, we've transformed the maturity profile, so our liquidity profile is strong. And our earnings, our core recurring earnings, have a nice stable base around 5 to 6 billion a quarter. And from there, we're now accelerating performance improvement based on both the revenue side and particularly on the efficiency side, as we hope to see that grow over the next year. And that accelerating profit growth will accelerate deleveraging and then eventually turn into more free cash flow available for dividends. So kind of pleased with where we are. We have turned the corner. We've moved out of turnaround mode, and we've moved into accelerated performance improvement, sustainable growth mode.
Okay, good deal. Well, let me run very quickly through the numbers we had without repeating too much of what Malcolm said. Then I'll give a little perspective from our financial analysis, and then we can jump into some Q&A if that works for you guys. So, guys, we're going to just skip through our presentation. So we had on our first slide the P&L, which showed pretty much the same thing Malcolm said, $2.5 billion profit for the quarter, which is down by 4%, but that 2.5 billion is after taking into consideration the 2.6 billion dollars in asset tax. So as Robert says, when you adjust that, you kind of feel like you're doing the 5 billion per quarter. And then we looked at the balance sheet, guys, on the next slide of our presentation, which sort of showed shareholders' equity increasing by 17% to $197 billion. So, kudos to you guys. No one can argue about the strength of your balance sheet, with over $2 billion in assets and $197 billion in equity. I mean, it's hard to not appreciate that NCB is, a really rock solid bank. We looked at the performance by segments, and as you said, you had 3 segments that were improving year over year. Then we had a slide. Is that actually being shown, guys? We had a slide up showing the quarterly performance, which showed the last 8 quarters. And again, your trailing earnings are $23 billion. So you are, in fact, averaging, more than that $5 billion per quarter. So that's pretty impressive. But we're not yet quite seeing it in the stock price. And when we look at our slide that shows the movement in stock price, the good thing is that, finally, after bottoming out at maybe $38, we finally see the stock price starting to shift, and you're up year to date by 9%. So we're finally seeing the stock price move a little bit. I would describe it as being roughly $42, but this is still substantially undervalued. From the perspective, folks, of PE, it's like a 4.7 times PE. And from a book value, it's 55 cents. Imagine the stock is trading at 55 cents if it's book. And when I look around, it's hard to see any bank or financial sector company or any respectable company in Jamaica that's trading that cheap. Like by comparison, and this is a comparison I've done for eons, Scotiabank is trading at 8.4 times PE, and they're trading over book value, like 1.05 times book value. Scotiabank's trailing earnings is $19 billion. Yours is $23 billion. Your EPS is twice as high as theirs, and yet their stock is trading twice as high as yours from a PE perspective. And that's, one simple reason why I know the stock at $42 is undervalued and will find its value closer to $84, $85, hopefully over the next 3-4 quarters, because Scotiabank is trading there. JMMB is trading at 5.6 times and 54 cents of their book value, but JMMB's had some challenges, and they definitely have to prove themselves to show that they can turn around that business, with their trailing earnings only being about $7 billion. So JMMB is definitely falling from where they used to be. Took some huge hits, forgive me, Angus, down in Trinidad with some investments, and they've got to clearly demonstrate that they can turn that business around to get back confidence. The other company that's also trading cheap, Rob, and I will ask this question later, is Guardian Holdings Limited. Again, trading crazy cheap on the Jamaica stock market, again at 55 cents a book. And so I'm not surprised there. But folks, from my perspective, interest rates are starting to trend back down. Yes, we went through Hurricane Melissa, and that definitely put a stumbling block in our progress as a country, but we can see already how quickly the macroeconomic variables are returning to normal. Interest rates are starting to come down. Liquidity is there in the market. We've got huge support to try to turn around the country. There's going to be a big push for infrastructure development. Inflation is, still under control. unemployment remains very low at its sort of all-time lowest, and so we know the focus over the next 3 years is to continue to keep debt to GDP down, to get it down towards that 60% mark. In fact, we probably got to 65, and it slipped back maybe to 70, 71. But there's a clear focus on the government, and they're showing their commitment to doing it, even in this tax budget that they're releasing, and showing that if we have to nudge up taxes and make a few adjustments here and there to get back on track, the government's committed to doing that, which is a good thing. And you see that in the country ratings and the outlook. So with all of what's before us and the push to come, it's hard to not expect that NCB is going to do great in this environment. And so that's why I wholeheartedly believe the stock is substantially undervalued. And that's my perspective as an analyst. Folks, why I think you need to run and get the stock while you can still get it cheap. 42, even up to $50, it's cheap, cheap, cheap. I want to see it getting closer to its true value. Even at the $5 billion trot, the stock should be an $85 stock. And I think ultimately we see you guys improving things like your cost to income ratio and showing us that you can improve your efficiency even in the chop. So it shows me that there's a commitment to reducing costs, increasing profitability, growing the strength of the business. And with a brand as strong as NCB and $2 trillion of assets under control, it's really hard to bet against NCB. So those are my thoughts. Let's start with the Q&A. And Patrick, I would like to kick it over to you to ask the very first question.
Thanks, Dan. So my first question is around NPL. So it looks like NPL grew to 4.9 from 4.3. How much of this is precautionary versus deterioration, particularly in Jamaica and Trinidad?
So on the NPL side, I wouldn't say that's we took extra provisions, but that wouldn't show up in the NPL, Patrick. So those are actually, again, just a couple of some of it is on the digital loan side, and some of it's just some chunky loans in Cayman that was held on both the bank NCB, so in multiple companies' balance sheets, but yeah, just a couple of chunky loans that increase that NPL ratio, and at the same time we'll expect some of them to run off over to cure over the next little while.
Okay.
Interesting. We talked about the Melissa impact, and it sounded like it was more on the insurance side of the business. Have you found that you're having impact on your loans, and is that turning up in your e-sales or your NPLs? How is it impacting your core commercial bank side of the business?
So a few different ways. So in the quarter that we reported, the biggest impacts would have been one, just the relief funding that we provided, as well as the fee moratoriums and fee concessions and things like that. So that hit the depressed fees and in the quarter. And the other part would have been we did take an increase some special provisions in the quarter, but that was it's a little bit more anticipatory, so that's more model driven, not so much anything that we actually see any deterioration in the portfolio, but it would be just looking at prior cycles and based on that proactively taking some increased provisions. So at this point, I would say we do see it obviously in the affected areas. We see it on the volume side of the business, but otherwise in the quarter it was just the fees, and those have gone back on in the second quarter. The volume of the business, there's probably a little bit of a lag. I think last time Gary spoke about this, and I share the same view, which is the growth kick is coming, because there's a lot of money that has to get put to work. So while there is a little bit of a dip in demand, that's just a lag. So I wouldn't say that we're seeing anything material just yet, Dan.
Right. And would you agree with me that the aftermath of Melissa, with the huge amounts of capital needed to rebuild infrastructure, that this creates a huge opportunity for a bank with a balance sheet as big as yours?
I think it creates a big opportunity for the country. This is this is multiple years of effectively of growth that can happen in a relatively short period of time. And so I think it creates a great opportunity for the country. It creates a great opportunity for a number of businesses. And in the financial industry, yours and ours, it's a big opportunity. It's also a big responsibility because if the rebuild money is not put to work smartly, then it can just spike up inflation and not get and not be put not have the same productive impact that it should have. So I think again we have a really big role to play, the entire financial industry, in working with the private sector, working with the government on to make sure that the money gets put to work in a way that doesn't just spike up inflation, but it actually spurs real growth.
Yep, same question kind of to you, Angus. How do you see you guys playing a role in the capital market sides with large infrastructure projects and PPP projects and whatnot? Surely this creates, again, great opportunity for NCB Capital Markets to get in there and find some solutions to help the country grow and make some fees at the same time.
Sure. So Dan, I have some bragging rights to claim today, right? So maybe 2 years ago, when I first came to Jamaica and took the role, I would have promised Mr. Almeida that I'll bring the capital markets back. And when we were on this forum 2 years ago, we made that promise public from recollection. So I'm very pleased 2 years later to say that given the amount of transactions that we've brought to market, debt transactions, equity transactions, we feel very proud that we've brought the capital markets back, not only in Jamaica, but we've spurred activity in Barbados and in Trinidad. So with respect to Melissa, there's a very clearly defined tactical strategy with respect how to make hay while the sun shines, so to speak. And we're just really focused on executing that strategy, Dan, as Jamaica moves to rebuild and as we move to accelerate it in lots of instances, bridging the financing that is promised to Jamaica to get things started while that external financing materializes. So a lot of our clients also are going to take this opportunity to not just repair, but to improve and upgrade their assets. And we are well positioned to support them in that regard. And as you would also see recently, we've been able to leverage the NCB Financial Group to wrap that ecosystem around transactions to make sure that the clients benefit from every aspect of what we do. And that is bank, capital markets, insurance, pension plans, etc. So we're really proud of initiatives that we've executed internally. Rob would have touched about, we did a lot of capital recalibration work, but we also did a lot of tactical changes. So we would have merged our corporate and investment banking operations. That has paid dividends almost immediately. We're interacting like we've never before. We would have recently announced the sale of our DTI in the Cayman Islands to Claren Bank, which is a part of our group. And that's really moving capital around where we think it works best, but also establishing centers of excellence, where we have talents across the group, across jurisdictions, across entities. We're moving to create centers of excellence to bring them under one roof and singular leadership. It builds scale, continuity, depth, economies. So in addition to capital recalibration, we're doing a lot of tactical recalibration. And I think that brings the stability in the results as we wrap the group around all these different initiatives and the clients we support.
Good deal, appreciate that. Patrick, any more questions from you? And remember, folks, if you've got questions, go ahead and post them in the chat group. We're going to start to get to them in the next 10 minutes.
Sure, Dan. So looking at the numbers, I see year over year there's a 4% increase in NII. With the interest rates going the way they are in this cycle, how do you project this will look over the next 2 to 3 quarters?
So when interest rates started to rise, as you remember, the policy rates went up 700 basis points. Our book doesn't reprice anywhere close to that. We actually had a strong amount of NIM, net interest margin compression during that time period. And so right now, we would expect to see NII and net interest margin expand, continue, at net interest margin, we'd expect to see expand a little bit, kind of hold flat to expand a little bit over the next few quarters. NII would grow both based on the NIM expansion as well as balance sheet growth. And so we would expect that to grow as well, probably a little bit more than what we've seen in the last little while. And at the same time, the marginal lending rates will start to, will reflect the lower environment. But the main thing for us is what's rolling off our books in some cases is pre-COVID financings that were at a time when interest rates were practically zero, and we've been carrying those all this time, and that's depressed our net interest income. That's starting to roll off our books and be replaced by higher rates relative to those rates, lower rates relative to a year ago.
Okay.
So notwithstanding the headline rates are probably coming down a bit, but at the same time, our net interest income and our net interest margin should actually continue to rise for the next little bit, just because of the lag effect that is there.
Okay. Thank you.
Good deal. Thanks for that. Malcolm spoke to the efficiency ratio improvement earlier, like 1 percentage point. And he was pretty modest about that. I mean, that's a significant improvement, Rob or Malcolm. And we talked about this, Rob, 2 years ago when you first started the program. You talked specifically about how you wanted to improve the efficiency ratio. How much further can you go?
We should be able for a financial institution of our scale, we should be able to get down, well into the low 50s in terms of cost income ratio. So if you take us from where we are now, that would still be about another 20 odd % of cost income ratio down. I would say so that there's still room to go there. Part of it will come out of the fact that income will rise and we should be able to get the operating leverage on our fixed costs on our technology platform. And so while revenue goes up a little, and if cost holds the line, the cost income ratio will keep coming down. In addition, we've got a number of big part of efficiency focus, as well as just the discipline of reducing waste everywhere, which is a combination of, well, it's just discipline. They're very, when you listen to the examples of things that we find just by being very, very granular. I'll just throw out an example. It's making sure you keep track of the number of licenses we pay for software. So I think we might have Microsoft licenses for everyone in the company that uses Microsoft Excel or uses Outlook or something like that. But employees come and employees go, and you have to keep on making sure that you're not paying for more licenses than you have staff. And so things like that in an organization of our scale, operating across as many jurisdictions, those little details can add up to a lot of money, because all of a sudden you're paying for a lot of licenses for, like I said, it could be Microsoft, it could be Oracle, just a number of different pieces of software we use, and you may just find you have extra licenses. Same thing with MasterCard and Visa cards. When people replace their debit cards and replace their credit cards, if we don't actually purge and clear out the previous card numbers, it means we're still paying a bit of a license fee for card numbers that are no longer being used, that are no longer active. And so it sounds like it's very trivial little details, but at our scale, the volume is so high that it adds up to a lot of money. And there is a lot of that still to be got.
Speaking of scale, when we talk about reducing your efficiency or improving it by 10 percentage points, you're talking about saving maybe $3.5 billion, increasing your profitability by like $3.5 billion per annum, right? Just to put that into perspective.
Yes. Yeah.
Okay. Gary, you've been quiet. I'm sure you have a question or two for these goodly gentlemen.
Yeah, definitely. I don't know if Rob was trying to preempt me, but it's not a problem. That's what good leaders do. Congrats, guys. I thought your results were phenomenal. Phenomenal from the perspective of the average person would think that it's flat. But, yeah, I was telling a couple of boards this last week, Jamaica got the worst hurricane in the history of hurricanes just in October. Basically a category 6. I mean, it destroyed one side of the country. And so for NCB to not only weather that with an insurance company, with a bank that is in every aspect of the country, with asset tax, it's I thought the result was exceptional. The question I have to ask is, you have a line item which I did some work on. It's called operational losses. And that item, when I go back about 7 years, that item used to average somewhere around 300 to 400 million. Unfortunately, for the last 5 years, that line item has averaged somewhere around $4.2 billion per annum. It peaked, I believe, last year at about 5.2 billion. My understanding of that line is that those are things that are within the control of management. I won't get into why it occurs, and I'll leave that up to you. I trust that you guys can fix that. And for me, I would like to know how quickly can you get back to that historical average of $400 million? Because, and then also in your calculation of the cost income ratio, do you adjust for those operational losses? Because those losses are one time and not necessarily recurring, regardless of the fact that it has occurred for 4 straight years. Do you include that? If you have included it, if we subtracted it, what would your cost income ratio look like? And more importantly, how quickly do you think you can get back to that historical average of $300 million?
Okay, I'm gonna give Malcolm a little bit of time to think about the numbers. I'll just give you some directional. So, again, these, just like I spoke about licenses, these things on operational losses are they're things like just reconciling. It's you think about the average person tries to reconcile their bank account, their checkbook. Our checkbook is a whole lot bigger, and we have lots of bank accounts across the insurance group and the banking group. And so something as simple as just reconciling your bank accounts and making sure that there aren't things that you haven't posted that are slipped away happens on our debit cards, happens on our credit cards. All of these things are tremendously high velocity, and if you lose a little bit here, you lose a little bit there, that you just lose track of it, it adds up to a tremendous amount. Again, our ABMs pump out a whole bunch of money, and just think, if somebody gets if somebody, sometimes people will say, "Hey, I put the money in for the deposit, but I didn't get the money. I didn't get it deposited to my account." And those types of reconciliations, we sometimes we'll give the client the credit for the deposit, but we haven't really found the money necessarily. So they're very granular types of things that repeat over and over again. So that's just to be transparent about what they are. That's what they are, and they're very much within our control. Having said that, in terms of fixing it, since the first quarter of last year, so now we've gone 4 quarters where we haven't taken any of those types of hits
Nice.
because we tightened it up. So I would say that when I was saying that the turnaround is behind us, I feel comfortable that we've got that pretty well under control, so that we can actually be back, be bold to say that we're back exactly to those numbers that you described. But we're getting pretty close to getting back to that right now, Gary. And I would say that within another quarter or so, I'd feel even more comfortable to say that that's all completely behind us.
Well, to put into perspective for the listeners out there, right? At $5 billion, $5 billion is $2 a share. That's $20 on the stock price, right? Um, you know, as one CEO to another, I mean, it's embarrassing in a way, but the fact of the matter is that it's within our control. And the beautiful thing, which is one of the reasons we keep recommending NCB stock, um, I'm sure yourself, Angus, etc., will put the necessary controls in place. And to our investors out there, NCB is writing off $5 billion per annum. That represents 30% of the bank's profit before tax. That's 15, they recorded $15 billion, I think, in 2025 before tax. That's 30% of the bank's profit. And so if they literally just put in those controls and tell everybody, stop, do what we hired you to do, right? I'm doing Rob, I'm helping Rob with the story, right? Do what we hired you to do. Literally, guys, it just flows straight to the bottom line. And that's $20 per share. There's $20 on the stock price. And if you think about $20, the stock is now trading at $40. So 50% of the current stock price is wrapped up in operational expenses that is totally within the control of the management of the company. This stock, every time I look at it, is buy, buy, buy. I leave it up to Dan to tell you what the book value is. I think it's closer to $90. It's still stuck in $40, and that situation that nobody wanted to talk about seems to be repairing itself. Why is the stock still down here? But I will answer that question, Rob. I mean, I'm trying to do your work alternatively. I said to you and Angus, I mean, it is definitely an area that you can get a lot of, we call it low-hanging fruit. And it's something that, I mean, literally, you can pick that fruit very easily. And as I said, you have a 30% jump in your profit.
Absolutely, Gary. Just being the term, Sheree Martin says, brilliant at the basics. So just keeping the focus on being brilliant at the basics. But it's a little bit more than a cliche. So the IT platform working takes away, it's when the IT platform is a little bit more volatile, it makes it harder to do the reconciliations. When the IT platform is more stable, it makes it easier to do the reconciliations. So having the IT platform upgraded, having our IT platform stable, migrating it all to the cloud, that all makes our platform more stable. Our ABM network is the service levels, the maintenance, the cash availability, the tightness of everything around the ABM network. The interesting thing is that the customers experience it when the customers are experiencing payment services working or not working, when their experiences ABMs working or not working. In the back end, we're probably also experiencing operational losses in addition to low efficiency. So when we fix those things, and I say when we fix, if I look back, we're talking about things that happened 4 quarters ago. So we've now had 4 quarters of pretty good performance that I'm getting more comfortable to say that I'm confident that it's behind us. But we've actually had 4 quarters of that type of stability, and that is the customer experience is better, operating efficiency gets better, and most importantly, those losses disappear, and that goes straight to the bottom line. So you're absolutely right. It's what our number one focus is on. And our group chairman would chastise me here because I would say it's our number one focus. And he says the number one focus of a country, number one focus of a business, number one focus has to always be on growth. But I say, like, hey, if we stop some of the leaks, it really all flows to the bottom line. And that's where I'm happy that we're at now, is we're going to keep the discipline on that at the same time that we can shift the focus to more growth.
Well, I have 2 questions for you, Rob. Before I ask the 2 questions, I'll remind you to remind your chairman that on this live, he did say the cost income ratio needs to come down. So if you're giving him a solution to reduce it, he can't change the parameters on you, right? That's
No,
one.
he's definitely driving us to get the cost income ratio down. He leads the chant on bring the cost income ratio down.
No problem. So the 2 quick questions. Your investment in Guardian. Guardian throws off a lot of cash. But we understand that getting US dollars out of Trinidad is a challenge. And the question is that excess dividend and cash that you get from Guardian, I mean, how quickly do you get it back here in Jamaica in US dollars? That's one. And 2, the last time we had you on, you indicated that, the dividend at the level it's at now, 50 cents a quarter. There are a lot of stuff you're dealing with, Basel III requirements, etc. I've seen where you've taken, in my opinion, some above normal provisions, etc. When should an investor expect or what would an investor need to see in the numbers to start to expect an increase in the dividend? And that is against the backdrop that, again, on the Mayberry Live, you indicated that ideally NCB wouldn't need to retain more than 50% of annual profits to grow the business. And, just to conclude, using your last profits, $30 billion, that would mean you're talking about dividends per annum of $15 billion, which would be significantly more than the $2. Right now, 2 times 2.5 billion, that's almost a 3 times increase. So when can we look towards a $6 dividend?
So the building blocks to get there are first of all is the growth in profit as we described. And so what we had as over the past in terms of the earnings, we had the benefit of Toma, the sale of the subsidiary. We had a number of one-off types of things. The core recurring earnings, as core recurring earnings start to migrate towards 30 billion, that's one part of it. The second part of it is that at the same time, where has the money gone over the last year? In Guardian, for example, it has actually been about removing a number of the pieces of friction that existed around. So it's just the way their balance sheet is set up it operates in so many countries that you have to move the money through the different countries and it has to be able to flow through all the various subsidiaries. So reducing those frictions, deleveraging in some of those subsidiaries, that is all being, again, most of that is behind us right now. And so that friction is reducing. And the third part is, as that free cash flow flows up to NCB, and we also have our a few other divestiture initiatives or internal merger initiatives that we're doing, capital recalibration, Angus calls it. Those will happen, and we'll start to repay debt over the next year, so hopefully over the course of 2026. And so in 2026, the increasing free cash flow will go towards debt reduction. And as we come out of that, we'll still have the free cash flow in there, but we won't have to do any more deleveraging. So if I was looking ahead, I would be saying 2026 free cash flow grows, but it probably likely goes towards debt reduction, and going into 2027, that same rate of free cash flow can actually go towards paying debt, increasing the dividends.
Thanks, Rob. Over to you, Dan.
Thank you, Rob. Thank you, Gary. Great insight, great questions there. And in our last 12 minutes or so, I'd like to turn to questions from our listeners on stream, on live. So, okay, first one is Philip Burgess. His question is, what's your outlook for the Jamaica stock market for 2026 in terms of opportunities or new listings? As well as performance from companies that are listed. So, hey, Angus, let me throw that over to you. What's your outlook for the capital markets, what you guys are going to do, and what opportunities you're seeing out there in the next year?
So, Dan, we're very proud to say that the first IPO on the Jamaica Stock Exchange for 2026 was done by NCB Capital Markets. That's Woodcats International. As you know, that was oversubscribed significantly. And what I would say to you is, when we spoke about interest rate trajectories, we spoke about NIM, but there's also another benefit to the NCB Financial Group, and lower interest rates creates more capital market activity. Capital becomes cheaper, people are more likely to come to the market to raise capital. So it spurs more investment banking activity, which is right up our alley. So I expect this trajectory to maybe not be as steep as before, but certainly going in a better direction for us. We make more money when interest rates are lower, if you could believe that. And that's going to serve the Jamaica Stock Exchange very well. And if we continue to do transactions like the Woodcats International deal and demonstrate that we still bring fundamentally sound value propositions, I think it would encourage others and encourage investors, especially if they have a good experience coming out of the IPOs that we're doing. So I think it's going in the right direction, Dan, to your viewer's question. And I'm cautiously optimistic going forward. The recent reduction in the policy rates certainly gave that a shot of adrenaline.
Yep. Can we expect to see any main market listings from you, Angus, this year?
Yes, we're working on a major main market listing that we want to bring to in 2026. That's going to be a large one. We're very, very excited about it. The runway is full with execution activities at this point in time.
Very good. Rob, did you want to make a
Sorry, Dan.
comment?
Yeah, I just want to, Gary, I think kind of alluded a little bit to this earlier. But it's also for the Jamaican markets is also a function of liquidity, right? So it's the liquidity in the market, and not to be lost, is when we did the 144 offering, the international bond offering, we effective by raising 225 million US dollars in the international markets. That money got paid back into the region. And so the amount of liquidity in the local and regional markets increased. Now, in a significant portion of the repayments we did were outside of Jamaica. They were in Trinidad and other markets. But going forward, we will continue to pay down more debt. And as we pay down more debt, it's a substantial amount of liquidity that'll be coming up in the market that people will have and available to invest. So if you think back to when the government was paying down debt and the amount of liquidity that was flowing into the market and what that did to the capital markets in Jamaica, our controlling shareholder just repaid a bunch of debt, and that's a pretty sizable amount of liquidity that flowed into the markets, and that would be local. And as that flowed in, those people have money to invest. And so I would suggest to you that, you know, we're not quite the same as when the government of Jamaica was paying down debt, but it's still at our scale, the amount of money that we're repaying, have repaid and will continue to repay, creates a large amount of liquidity in the market that will be looking for investment homes. And I think it is really it's opportune that we've got a big rebuild and there's a lot of activity and it should be a lot of good places to put that money to work.
Yeah, but I agree wholeheartedly. And remember, there's substantial amount of monies on repos and government papers and stuff like that. Over $140 billion is on 30-day repos, right? And those interest rates, as they start to come down, Angus, to your point, I think folks will start to think about, okay, I can't sit at home and earn 6% anymore. Those rates are now down to 4%, so I'm barely keeping up with inflation. So maybe I need to think about a different asset class, and that's where the IPOs present themselves. So there is a substantial amount of liquidity here as well too. Thank you for the $94 million payment, Mr. Lee Chen, and for you guys bringing $225 million into the market. But there's a substantial amount of liquidity here. I think a lot of it also has to do with investor confidence. You touched on it a little bit, Rob, but I'll ask the question anyway, because if you asked it, I want to make sure we answer it specifically. You know, what's your roadmap for deleveraging the bank and refinancing at lower cost, and how will that translate into additional free cash or improved profitability for the bank?
So we've got transactions that are programmed right now that would be expected to enable us to pay down about 20 billion of debt in the next, well, call it within the next 2-3 quarters. And so if you were to, so that's kind of the roadmap, and then in addition to that, as mentioned with Gary, the free cash flow we're generating, we'll use some of that to pay down some debt as well. So there's more than, so we should be paying down about $30 billion over the next year or so, and that in and of itself, will add about reduce interest costs by about $3 billion, and that flows straight to the bottom line. Then with the lower debt profile and the more liquidity in the market, lower saturation of our own name, some of that money will hopefully go into NCB stock. And as it goes into NCB stock, the stock price will rise. But what it'll also do is it gives us a chance to start the refi activity at lower rates. And so we will start to be in a position where instead of being effectively a price taker and pricing out the market, we'll actually get the benefit of the strength of NCB and get those lower rates that are otherwise our international ratings and others would justify us getting lower rates. But just the sheer volume of the amount of debt issuances we had to do drove the rates up. So there'll be two sources of profit improvement that'll come from that. One will be straight interest expense because the volume of debt goes down, and then we'll actually be able to actually reduce our interest cost, and that will probably take our overall interest cost down by another 20% or so.
Good deal. And then the last question I'm going to ask is really three in one, because a lot of people seem to be asking questions about this Claren transaction. What was the logic about Claren purchasing NCB Cayman? Are you guys still thinking of divesting Claren? Is it still viewed as non-core asset? And somebody even asked, could we see possibly a separate public listing for Claren? So three in one around Claren.
So Clarion, we've gone through a lot of work at Clarion since we first invested in Clarion, and Clarion is performing very well right now. And they have they've migrated their entire technology platform to a cloud-based service platform. And what they need to do is they need to actually increase the amount of scale, take advantage of the economies of scale. So they need to start expanding on that base because otherwise they're capped by the size of Bermuda. And so what makes sense is for Clarion to leverage that platform. Cayman is a similar type of economy, similar type of demographic. And what that enables, so Clarion is a natural fit for Cayman. It's a better fit for Cayman than NCB is. And so we would look for Clarion to keep to leverage the Clarion value proposition, customer service proposition, to grow in the Cayman market, to grow the NCB business in the Cayman market. So to create that center of excellence and leverage it for growth and improved efficiency because we get more leverage on the fixed cost platform. And then to actually continue to expand in similar markets, just like that are, and that would be the opportunity for us to grow in that space, which does raise the it's a really good question about, do you see a separate listing for the Clarion type business? If there's on an overall scale perspective, there's a benefit to having it part of NCB, and at the same time, you'll see when you look at some of the international banking competitors, I won't call the name, but some of them try to keep themselves pure play in countries that are investment grade rated, and so it's a very interesting question that says one day when that business gets up to a larger scale, then whether it'll make sense to take advantage of the investment grade ratings of the countries in which it operates to actually get to have a separate listing. It would be an interesting assessment. We have to scale it up first, so we won't get ahead of ourselves. First things first, we'll just focus on the integration and scaling up the business, and then we'll focus on the options that come from that.
Okay, good deal. I appreciate that. So Gary, unless you have any more questions, or Patrick, unless I think we've had a good run.
No, I think it's clear. I mean, every time I hear Rob talk about paying down debt, I'm just saying increase profit. $3 billion in interest savings is $1 a share times 10 times is $10 more.
Yeah, man.
I mean, if he was female, I'd marry him. He just had all these wonderful goodies. And I said to people out there, how is it after Mike paid $94 million, the stock is still at $41? It's a giveaway, right? I use last month's salary and buy. I don't borrowing to buy because it's not a matter of if, it's a matter of when the stock gets to $150.
100%.
That's fine. Keep it at 40. I'll continue to buy. Okay, hear what Rob said. $3 more billion, paying down interest expense. And then you get more cash to lend more money, and they lend at an average rate of 12. You just profit up on profit up on profit.
Absolutely. So I
Give a piece like bonus, Rob.
Well, guys, listen, in all seriousness, again, it is my favorite stock, and it has so much potential. And this is a stock, Gary, I don't need to tell you, at $150, where it traded for over 3 years, traded more than $40 billion in volume. So this is a stock that trades with great volume. It's one that you want to have in your portfolio. If you're a big pension fund, you absolutely must have NCB in there. If you're like me and your average cost is $65, just hang tight. It's going to come around. Book value is $85, and I think it has the potential to get to $120 in the next 12 to 18 months. And then ultimately, I think the sky really is the limit as they do all the things we just discussed, improve the efficiency ratio, restructure the debt, get rid of the operational losses. I mean, there's just so much you can do to the business, and it's trading today at 4.5 to 4.7 times P. So even at today's steady state, the stock should be worth twice as much. Imagine if they can squeeze out $7-8 billion more costs, which alone drives the profit, the share price by a further $40, $50. So it's definitely a stock in my mind that you want to watch, that you want to have in your portfolio. You can't have enough of it, and I think it's it has one of the greatest potentials for growth in the next coming year. And I'm very bullish on the Jamaican economy. I'm a big fan of the Jamaica Stock Exchange and the potential growth that's out there. There are other stocks. Today we're talking about NCB, which truly is my favorite. And this isn't like talking to my girlfriend when I say you're my favorite girlfriend, and next week I said to the other one, you're my favorite girlfriend. You guys really are my favorite. So Rob, Malcolm, Angus, thanks for being here. We really, really, really appreciate you guys coming out. We look forward to having you back after the next quarter's results, where there's no more asset tax repeating itself. So we should see the $5-6 billion clean, plain that even a blind man could see it. So with that, I'd like to bring today's discussions to an end and thank all our viewers for tuning in as usual. We truly appreciate your support, and big thanks to Robert, Malcolm, and Angus for being a part of the show again today. Really appreciate you guys. Of course, also thanks
Thank you
Patrick.
very much for having us.
Thank you,
Pleasure.
guys.
Pleasure,
Have a good
pleasure,
one.
pleasure. Of course, Mr. Peart and his SVL cap, and Patrick without the cap. Thanks, guys, for being here. Really appreciate you too.
No
And
problem,
folks, if
Dave.
you're curious about our updates on our virtual investor forum, then you need to find us on social media, where we share our live stream updates and our upcoming programs on social media. So give us a follow-up to learn about all things forum related, and join us again next week when we do this all over again, this time looking at Jamaica Teas. Don't forget to subscribe to our YouTube channel, Mayberry Investments Limited, and click the bell to receive future notifications. Well, remember, wise investors, slow and steady wins the race. Keep safe, everybody. Bye, guys.